Welcome to Make Your Money Matter with Brad Barrett, the show that aims to change the way you think about wealth management. Brad is a financial advisor, established radio host, and author of Retire Right. He is a managing director and partner at One Capital Management, an SEC-registered investment advisory firm managing over $4 billion for clients across the nation. Brad and his team are dedicated to helping clients protect and preserve their assets so they can reach their investment and retirement goals. And now, your host of Make Your Money Matter, Brad Barrett.
Welcome in to Make Your Money Matter. I'm your host, Brad Barrett. I'm also a managing director and partner here at One Capital Management. And being that it's Halloween, I'm going to talk about something scary. Now, to us nerds here, what's scary is volatility and things like money. So I'm going to relate it there. That's my bridge for today. Very spooky, I know. But I want to talk about the notion that nothing's free. There's an old statement that was made by Milton Friedman, a very famous economist, who said there's no such thing as a free lunch. And we're going to talk about that today as it relates to the price tags we all have to pay as investors aren't necessarily in dollars and cents. It's things like doubt, things like fear, things like anxiety, uncertainty, the emotional swings that we have to go to. Because again, everything has a price in life, but not all prices appear on labels. But before we get started, make sure to go to our website at onecapital.com. You can click on the media tab. You can download and subscribe to the Make Your Money Matter show. You can also download our podcast on any other platform, whether that's the Apple iTunes app on your phone, Google Podcasts, Spotify, or SoundCloud. And do me a favor, leave us a message, leave us a review. It helps us share the word and get the show out to more and more people. And with that, let's get started. So as always, for many of you who listen to the show each and every week, you know I'm a big believer in psychology because what I've seen play out as an advisor for nearly 2 decades now is the emotional and rational war that goes on all the time. Now, I've referenced this a couple times, but I went back and reread something over the weekend. I'm a nerd. I like to read books. I'm heavily into them. And it's a book I've talked about often on the show. And it's called The Psychology of Money by a guy named Morgan Housel. It's basically designed to discuss timeless lessons on wealth, on greed, on happiness, and the intersection between our joy of life as a human, as a rational, logical human, as well as emotional beings. And there's a chapter that stuck out to me as I was rereading, and it comes from conversations I've been having with clients, many of you even listening right now. I think one of the biggest misnomers that's going on, this is a weird year, right? Because if you look at the S&P 500 as an index, which by the way is just that, it's just one index. It's the largest 500 domestic companies in the United States. That's it. So it's not, doesn't account for international, doesn't count for smaller companies or middle-sized companies or real estate or commodities. No, it's just the 500. Now, we deem that as quote unquote the market. Now, others will also use the Dow Jones, which is the 30 largest companies, specifically in certain arenas that makes up the Dow Jones Industrial Average. I've spoken on this before at length. Now, here's what I want to bring up is if you look at the S&P 500 on where we stand right now, it's roughly up 8-9%. If you looked couple weeks ago, 3-4 weeks ago, end of September, it was up in the mid 15s and 16s. Now, here's my point. If we looked at it then as a spot in time and said, oh my gosh, the S&P 500, the equity index is just doing like gangbuster growth and my account's only doing a couple percent, what gives? There's something that's got to be wrong or the manager is just poor or something like that. And the reality is, friends, you can hear this loud and clear, diversification matters when things are overbought. And I want to share this very clear. There's 500 companies in the S&P 500. There's actually a little bit more, but that's another story. 500 rough companies. 11 of them, 11 of them are what is pushing the index up. We here at One Capital actually own 6 or 7 of those. So the reality is it's how we weight them, WEIGHT, as a relation to their overall index. Case in point, 3 weeks ago, the thing went down 7 or 8 percentage points because it's been a terrible October so far in the index. And guess what? Largely, our portfolios haven't moved much. Price sensitivity and understanding volatility really matters. Now, in the book, Psychology of Money, he talks a lot about this. And by the way, if you haven't read this, please go out and buy one. Or I'll tell you what, I'm going to offer this to everyone this week. Email me and I will send you a copy on us. You can email me at bbarrett@onecapital.com. Again, bbarrett@onecapital.com. Just give me your name and your address and I'll send it to you. It's an amazing book and it's a great investment I would love to do for you. So please, I'm dead serious. Email me and I will send you this book. Chapter 15 literally goes into one of the things I talk about all the time. And I'm going to use this as a reference point today. The chapter is titled Nothing's Free. Now, as I said before, everything in life has a price. And the key to a lot of things with money in particular is just figuring out what that price is and being willing to pay it. Said differently, we all assign value in different ways. I spoke about this a couple weeks ago when it talks about the value of, say, a financial advisor. And everyone deems advice or value and other things in life differently. And I want to share this as a story because Morgan Housel went through this in this chapter, and I think it's a good one for perspective. Now, General Electric, many of us know that company. It was the largest company in the world in 2004. Literally, the entire world, 2004, largest company. It was worth $1/3 of $1 trillion. It had either been first or second each year for the previous decade as well. It's basically, what we've always known in our life as capitalism's shining example of corporate aristocracy. Now, flash forward for something, everything fell to pieces, right? A lot of us know this story, but I want to walk through this here. And he goes through it in this book. In 2008, during the financial crisis, it sent GE's, basically their financing division in particular, which supplied more than half the company's profits, that's important, into absolute chaos. It was eventually sold for scrap. Subsequent bets in oil and energy were disasters. If you go through the history of it, it resulted in billions in write-offs. And the stock for GE fell from around $40 in 2007 to $7 by 2018. Now, here's what I want to bring up here. All the blame, essentially at that time, and really since then, has been placed on the CEO, a guy named Jeff Immelt, who ran the company since 2001. I mean, if you look back and you can reread this, and I did some of my own research as well after reading the book and Morgan going through this as well. I mean, he was criticized for his leadership, for his acquisitions, for cutting the dividend, for laying off workers, and obviously the plunging stock price. So, and rightly so, by the way, because those rewarded with dynastic wealth when times are good hold the burden of responsibility when the tide goes out. We know this. It's part of America, right? Right or wrong, it's the truth. And Morgan wrote that exactly that way, and I loved how he said that. Now, just to your own reference point here, Jeff Immelt, the CEO, he stepped down in 2017. But here's what I loved about this story. Immelt said something insightful on his way out. And that's what I want to share with everybody, okay? He was responding to critics who said his actions were wrong and what he should have done was obvious and so on and so forth. And Immelt told his successor, the guy who replaced him as CEO, he said, every job looks easy when you're not the one doing it. Every job looks easy when you're not the one doing it, okay? Why? Because the challenges faced by someone in the arena are often invisible to those in the crowd. For many of you who've heard Tom Brady in particular quote the famous Teddy Roosevelt speech around the man in the arena, this is what's speaking to that, right? Dealing with conflicting demands of sprawling bloat, short-term investors, regulators, unions, and all the stuff they need to deal with, right, is not only hard to do, but it's hard to even recognize the severity of the problems until you're the one dealing with them. Like Immelt's successor, who, by the way, only lasted like 14 months, learned this well. Most things are harder in practice than they are in theory. And I share this simply because I've had a lot of clients and discussions lately around, and I spoke about this a couple weeks ago as well when it comes to the value of the advisor and the whole do-it-yourself and understanding roles here. I mean, most things are harder in practice than they are in theory. We can get in our heads sometimes and be like, compare advisors, compare managers, compare, even your buddies investing or portfolio. And I'm just speaking to the money world. We do this also in life as well. But sometimes this is because we're overconfident. And I think it's important to just take stock in that for a second. More often, it's because we're really not good at identifying what the price of success is, which prevents us from being able to pay it. My point is, we're hard to understand the price tag on where we place value.
Stay connected. Get frequent updates on the show. Follow Brad Barrett and Make Your Money Matter on most social media platforms. And catch full episodes of Make Your Money Matter streaming now on our YouTube channel. To schedule your no-obligation appointment, go to onecapital.com or call 805-410-5454.
Now, let me go into another story that Morgan talks about very heavily here. And I think this is what speaks to everyone right now. And if you're listening here, it's important to remember this because I think the biggest thing we're seeing this year, and especially coming off the heels of last year, is this long-ended volatility of a bear market last year, seemingly back up this year, but now floating around, and just all the uncertainty that's out there in the world. And you've heard me say these kind of stats before, but it bears repeating, okay? The S&P 500 has basically increased 120-fold in the last 50 years, ending a couple years ago. And Morgan talks about this in his book. all you had to do, as I share this often, was sit back and let your money compound. I always share, it's like if you invested in the S&P 500 30 years ago and just fell asleep or lost your password, like you would have made over 10%. And I talk about this a lot because emotions and our natural human behavior is what holds us back. But of course, as all things, right, successful investing looks easy when you're not the one doing it. Said differently, successful investing looks really easy when everyone around you and the markets are good, everyone's feeling good. It's the true winners that are made in years like this. As I share often, it's not always what you do, but what you don't do in years like this that matter. Now, you'll hear this all the time, and I've definitely been accused of saying this, and I say it all the time because I mean it, because I've done the research, the empirical data, I have the experience to back it up, but I want to say this for everybody loud and clear. Hold stocks for the long run. It's good advice. It's sound. And you look at historically, it makes sense. But let me just pose a question that the Psychology of Money book goes into. Do you know, and ask yourself this, do you know how hard it is to maintain a quote unquote long-term outlook when stocks all around you or the index or your friends are just, collapsing out of uncertainty or fear or anxiety? It's really hard, is it not? You can call me, email me right now and tell me like that, oh no, Brad, I have no problem with it. And here's how, because if you found the anecdote to that, let me know, because I would love to share that with many, many clients. And here's the thing, guys, it's normal. I'm not sharing, you're not out over your skis on this. You're not weird. You're not, abnormal. This is a very normal thing, which is why I'm saying this, right? But let me sum it up this way and how Morgan Housel wrote this in The Psychology of Money. Like everything else in this world that we live in that's worthwhile, successful investing demands a price. But its currency is not dollars and cents, okay? I'm not talking about a price from a dollar perspective. The price that we have to pay for successful investing is volatility, is fear, is doubt, is uncertainty, and yes, maybe even regret. All of which, friends, are easy to overlook until you're dealing with them in real time. Now, I'd ask you right now, are some of those things I mentioned, volatility, fear, doubt, uncertainty, regret, are those things you're dealing with right now, given what's going on around this world and the markets and just everything we see? Because if it is, and by the way, like many of my clients and many of the investors in this world that I deal with every day, they're feeling that way. And by the way, as I shared before, that's very normal. It's humanistic. We're emotional beings. That's okay. But this is what I'm sharing at the top of the show around the notion of nothing is free. The inability, I think, for all of us to recognize that investing has a price can really, it can tempt us to try to get something for nothing, right? Which is basically like, think about it. It's like shoplifting, which rarely ends well, okay? It's like, you're trying to, I'm gonna take this Snickers bar, and obviously it's illegal to steal, right? But we're trying to get something for nothing. Like, and this is what Morgan brings up in this book, and I love this example, right? Say you want a new car, okay? But the car costs you, let's just say $30,000. And you have three options, right? And I deal with this with clients when it comes to financial planning. The options are pay $30,000 for it. The second option is find a cheaper used one. Or the third one is to steal it. Now, it's obviously dramatic in the third one. But in this case, 99% of people know to avoid the third option because the consequences of stealing a car obviously outweigh the upside. But say you want to earn a 10% annual return over the next 30 years so you can retire in peace, right? Now, I want to ask you, for everything I've shared today, does this reward of earning 10% per year come for free? Of course not. The world is never that nice to us, okay? There's a price tag, a bill that must be paid. And in this case, it's a never-ending, call it this way, it's like a taunt from the market, right? Which gives big returns and takes them away just as fast. Which is why I really share all the time that the way to manage this volatility, manage the long run, is through diversification and active management. I will go down to my deathbed saying that. I've seen just so much empirical data, and I've seen 19 years of being in the financial services industry show me this. And I've gone through a lot. I've gone through 3 or 4 presidential elections. We've gone through a financial crisis and two 50% market downturns, a global pandemic, Brexit. You name it, government shutdowns, tumultuous presidencies. I've seen enough in 19 years. I haven't seen everything by any means, but I want to share this from experience that diversification is the soothing ointment, the medication, if you will, to the price that we have to pay to achieve the long-term results. Remember, the price being not a dollar amount per se, but it's the other things, the things we don't talk about, right? The price is volatility, the price is fear, the price is anxiety, the price is doubt, the price is uncertainty, it's regret even. So I share this simply to say that it's important that we all put into context how we are sharing our performance numbers, how we're discussing them, how, really, as I always share, right? If you're not working with an advisor, make sure you find one, because this really matters. This is the anecdote to this also is through discussion points, through planning, through meetings with an experienced person to help you walk through them. Because if left to our own vices, and by the way, I'm the same way, I share this often, right? Like I like to think I know what I'm doing, and half my adult life, in fact, half my life in general has been spent doing this. I still have the same portfolio manager manage Veronica and I's assets as I do the same ones for my clients. Because at the end of the day, I'm still human. I still, have the same fears and anxieties as you would, even though I've seen the data. Like it's right in front of me and I know what I need to do, right? But at the same time, I also know myself and I know I might overreact. And again, as I share, it's the things that we don't do that almost matter more than what we do. And I think that plays out in our investing life. And I should share something and clarity here. When I talk about the long run, if you're listening here and you're in your 60s maybe, and you're like, well, Brad, are you just talking to only 30-year-olds? No, I'm talking to you as well. Because last I checked, you didn't expect to go into retirement or into your 60s or 70s only planning on living 1 or 2 years. I don't have a single client of mine in nearly 2 decades of doing this is that, Brad, I'm only planning for a year's worth of retirement. Like, we don't know when God's going to call us back up. But God willing, we have the same amount of time that we had in our working years in retirement. So yes, I'm 100% talking to you, those in their 60s, 70s, even 80s, because in my world, and again, this is subjective, but anything north of 2 or 3 years is longer term. This is why I'm having conversations right now with clients who are investing for their retirement. And I understand that money markets and treasury yields are very high yielding. I've spoken about that a lot on our show, and it's a good place for cash assets that is above and beyond your emergency fund, but it's not necessarily the long-term investment play for your overall retirement. It could be a part of it, but it shouldn't be the only thing, because those risk-free rates ultimately will come down. We don't know how fast, but we want to manage that. And understanding that in the long run, value and growth and dividend stocks, along with fixed income and diversifying yourself with real estate and commodities, all things that we do for our clients here at One Capital, really is what plays out. And I think, as I shared a couple weeks ago as well, comparing an investor or just a portfolio manager, comparing someone to 30-year data set facts, like I mentioned, like the S&P 500, if you go back 30 years, and you just invested, roughly you'll make over 10%. That's the last 30 years of the S&P 500. To compare 30 years of data to 1 year's performance is crazy. I mean, that's like literally the comparison of apples and oranges. So the idea here is context and future-oriented growth. And more importantly, the peace of mind, which is another anecdote here. Well, actually, sorry, it'll be more the outcome of having these anecdotes to these price tags. Again, the price tags being your fear, your anxiety, your doubt, all the volatility that you're seeing. So if that's you this week, understand that putting price on something isn't necessarily like, the old MasterCard, right? Commercials we always saw. It's priceless because it's not necessarily a dollar amount you're paying. It's the emotional swings that you're taking. So achieving, I've had a couple, and I brought that statement up about those that want to receive, 10% per year. And I get that on the backward side. You see that kind of looking backwards. That's what it's been. And who's to say it's not going to be what's going forward? But if you lose sight in years 1 and 2 or years 15 or 16, or heck, even in years 27 or 28, you're going to lose sight of the bigger picture. Like the old saying says, don't lose the forest for the trees. Hey, I want to thank you for listening to the Make Your Money Matter show. As always, before acting on anything discussed today, make sure to speak with a financial advisor near you about your specific situation. Or again, if you'd like our help, you can reach us at 805-410-5454. And until next week, always remember to make your money matter.
The information in this show is educational and general in nature and does not take into consideration a listener's personal circumstances. Therefore, it is not intended to be a substitute for specific individualized financial, legal, or tax advice. To determine which strategies or investments may be suitable for you, consult the appropriate qualified professional prior to making a final decision.